You don't expect a giant, established company to suddenly start growing like a hot new startup, right? Well, that's exactly what's happening with Kalyan Jewellers. We're going to dig into their incredible story, and it all kicks off with this one absolutely mind-blowing number.
42%. Just let that sink in for a second. That's the number that has everyone talking. In just one quarter, Kalyan Jewellers boosted their consolidated revenue by a staggering 42%. For a company of their size and history, that's not just growth. That's like hitting the accelerator and just taking off like a rocket.
Now you might be thinking, okay, one great quarter. Could be a fluke, right? But here's the thing we're going to show you today. This is absolutely not a fluke. This is the payoff from a really smart, deliberate strategy they've been putting into place for years. It's pretty brilliant, actually.
And we've got the inside scoop on how they did it, all thanks to a deep dive report from the credit rating agency ICRA. Think of them as the financial detectives here. They've basically given Kalyan a huge thumbs up, and their report lays out the whole secret playbook. So let's jump right in and look at those headline numbers.
All right, first up, Kalyan's golden quarter. Let's take a look at the headline numbers that are driving all this excitement. Before we get into the how, let's see the what.
And wow, this growth is everywhere you look. It's not just one part of the business doing well, it's the whole engine firing on all cylinders. We're talking a 42% jump in their main Indian business, another 36% internationally, and then, get this, their digital brand, Candera, just exploded with a 147% surge. That's not just healthy growth, that's a company that is absolutely on fire.
So the big question is, how on earth are they pulling this off? Well, the secret is a huge shift in their strategy, something called an asset-light model. And this is where it gets really interesting.
Think about it. If you're a big retailer and you want to grow fast, you've got this massive problem. Opening new stores costs an absolute fortune. I mean, imagine stocking a jewelry store. You're talking millions and millions in gold and diamonds just sitting there. So how did Kalyan crack that code?
They did it with this thing called the FOCO model. It sounds a bit technical, but the idea is actually super simple. It stands for franchisee-owned, company-operated. Basically, a franchisee partner comes in and pays for all that expensive inventory. Kalyan, in turn, does what they do best. They run the whole show, the branding, the operations, the sales. It's a you fund it, we run it kind of deal.
So let's break that down. The old way, the COCO, or company-owned model, meant Kalyan had to foot the bill for every single piece of gold. Super expensive, right? It really put the brakes on how fast they could grow. But now, with the FOCO model, the franchisee takes on that inventory cost. And just like that, Kalyan is free. They can expand like crazy without having to pour their own cash into inventory. It's a total game changer. And you don't have to take my word for it, just look at the numbers. Since they made this switch, they've opened a whopping 193 franchise stores. Compare that to just 41 of their own company-owned ones. The numbers speak for themselves, right? They are all in on this new model.
Okay, so this new financial freedom isn't just about opening more stores. It's about opening the right stores in the right places. And that brings us to the second part of their secret sauce, expanding way beyond their home turf in the South.
And the change has been just incredible. Just a few years back, Kalyan was really seen as a South Indian brand. Only about a third of their money came from anywhere else. Fast forward to today, and that is completely flipped on its head. Over half, 52% of their revenue in India now comes from outside the South. That's a huge transformation.
And they're not stopping at India's borders. They're becoming a truly global name. They've got a solid foothold in West Asia, and they've just pushed into the US and the UK. Think about this, 469 showrooms total, with plans to add another 170 in the next year. The speed is just wow. But here's a really cool and crucial side effect of all this expansion. As they move into these new areas, they're not just selling more jewelry, they're selling more of the good stuff. The diamond-studded pieces. And that stuff has way higher profit margins than just plain gold. So it's a double win for their profits.
All right, so let's talk about the financial payoff. How does all this great strategy actually translate into hard numbers on the balance sheet?
Check this out. This is the first massive impact of that FOCO model. The number of inventory days, which is just a fancy way of saying how long a piece of jewelry sits on a shelf before it's sold, has absolutely plummeted from 221 down to 156. Why does that matter? It means their cash isn't just sitting around collecting dust as inventory. It's a huge, huge boost to their efficiency.
And that efficiency leads directly to this beautiful number. Their return on capital employed, or ROCE, has jumped from 8.9% all the way to 14.4%. All that really means is that for every single dollar they invest in the business, they're getting way more profit back. That's the kind of thing that makes investors very, very happy.
So this table really just puts it all together, doesn't it? Inventory days are way down, returns are way up, and the result? The actual cash the company is making has pretty much doubled in just 3 years. The proof is right there in the numbers. This asset-light strategy is an absolute home run.
Okay, but it can't all be sunshine and roses, right? Every great story has its challenges. So, to give you the full picture, we've got to look at the potential risks that ICREA, our financial detectives, also pointed out. So first up, you've got the usual suspects for this industry. We're talking intense competition from, a million other jewelers. There's the roller coaster of gold prices, which can change in a heartbeat. And of course, you always have to watch out for new government rules or seasonal dips in demand.
And there is one key trade-off with this awesome FOCO model. You see, to get those franchisees to put up all that cash, Kalyan has to share the profits with them. That means their own operating margins have come down a little bit. But think about it. It's a really smart trade. They're choosing to take a slightly smaller slice of the profit from each store in exchange for having a whole lot more stores. They're growing the whole pie.
So when you step back and look at the whole picture, it's really a masterclass in business strategy. Kalyan Jewellers figured out how to switch from this slow, heavy, capital-intensive model to a fast, agile, asset-light machine that's just built for explosive growth.
And that brings us to a really interesting question to leave you with. Kalyan clearly cracked the code for the jewelry business. But could this FOCO model, this you fund it, we run it idea, be the future for all kinds of big box retail? I mean, think about furniture stores, electronics, you name it. It's definitely food for thought.
And that's our look at Kalyan's incredible growth story. Thanks so much for tuning in, and we'll catch you on the next one.